Hello traders, welcome back to the Forex Geek, where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the bearish side-by-side white lane pattern, a powerful yet often misunderstood continuation pattern that could significantly improve your trading precision. You will discover why this three candlestick formation, despite showing two bullish candles, actually signals a strong bearish continuation. So stay tuned as we break down the exact criteria, optimal entry points, and risk management strategies that will help you effectively trade this pattern. So we start by understanding the core structure of this bearish side-by-side white lane pattern. And this is the formation. This formation consists of three distinct candlesticks that tells us a clear story about the market sentiment and price action. Now, the first component you will need to identify is a large bearish candle. A large bearish candle, this represents strong selling pressure and confirms that bears are in control of this market. Following this bearish candle, the market gaps below. There must be a gap below and open, but where it is get interesting is you would observe two consecutive white or bullish candle after they have opened, after the bearish candle gaps in price. This bullish candle might appear contradictory in your bearish pattern, but their placement and relationship tells us a deeper story. The key characteristics is that you must remember at this pattern, two white candlesticks have similar opening and closing price. They should have similar opening and closing price. More importantly, they fail to close the gap. So whatever you see here, whatever candlestick pattern you see after the gap in price, they should fail to close the gap. This failure to recover is what makes the pattern bearish despite the presence of the bullish candles. The structure reveals an important market dynamics while buyers attempt to reverse the downtrend through those white candles. This inability to close the gap confirms that sellers or selling pressure remains dominant. You can think of it as bears allowing bulls to exhaust themselves before assuming or resuming the downtrend. Now that we understand this pattern, let's focus on how to trade it effectively. We focus on how to trade it effectively. A proper trading strategy requires more than just pattern recognition. You need specific entry criteria, precise risk management, and clear profit targets. We first examine the ideal entry conditions. You want to confirm the three elements before taking any trade. Before you enter any trade, you have to confirm those three elements. The optimal entry comes after the formation of the second candle. The optimal entry comes after the formation of the second bullish candle. We have to place our sell order slightly below the low of this candle. We'll place it slightly below the low of this candle. That is, at this area, we'll place it slightly below the low of this candle. This approach allows you to enter the market only after the pattern is fully developed and confirm bearish continuation, as seen from my screen. For risk management, your stop loss should be placed above the high of the initial bearish candle. That it has to be closed at, you have to be placed at the high of the initial bearish candle, that after the candle that caused the gap. This is the candle that you put it at the high of your stop loss at the high of the candle. This approach allows you to enter the market after the pattern has fully developed. Do not forget, that is why we have to enter after the second bullish candle. This placement protects your position. Where we place our stop loss protects our position while giving the trade rooms to breathe. We also give our trade room to breathe in case market decides to come up and misbehave, or in case the pattern is a failed pattern. Putting our stop loss at this area gives the trade enough room to breathe. The key is to keep your risk controlled. And never risk more than 1 to 2% of your trading capital on a single trade. So whenever you see this trading pattern, never risk more than 1 or 2% of your trading account on a trade. Let your trading, at least you should risk 1% or 2% of your account. When it comes to profit target, you would want to implement a two-tier exit pattern. You first of all place your take profit order at a distance equal to the height of the pattern. You can decide to take your take profit at this area. You measure the distance from your entry to the height of the candle. From your entry here to the height of this candle. This can be your first take profit target. You measure it and you put it at this area. You put your stop loss, you put your take profit at the area of your area measured for a 1:1 risk to reward ratio. Then your second target should be at least twice the distance. So your second target can be twice the distance of your measured value. So when you measure the first time, you measure the second time, and this can be your second take profit. This is how we secure our take profit. This is where we place our take profit when entering a trade using this strategy. This approach allows you to secure partial profits while letting the remainder to run. That's in case you want to make use of a partial profit method. You want to use a trailing stop loss for this strategy. It will help you to secure partial profits while letting the remainder run for a potential larger gain. Remember to always check the border market context. You have to always make sure that you are in line with the market structure before making use of this strategy. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thank you for watching, and I will see you in the next video.